Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Friday, July the 4th, 2025. Of course, it's Independence Day in the States, so cash markets are closed. The future markets have low volume, but are technically open for another few hours. So it's a good moment just to sort of pause, and we'll just look here for a couple of minutes, get a bit of an overview. What's kind of interesting for me is just looking at the non-farm payrolls data yesterday and ISM services. If we actually look at the data, so let's just have a look at the data. And we know that the market interpreted this as pretty strong data yesterday. So if we actually look and have a look here, so this is the non-farm payrolls. Again, I don't have the connection to Bloomberg up, so I'm going to just have to use here trading economics. But non-farm payrolls, so it did come in at it came in at 147,000, which was well above consensus, which if you remember was between about 100 and 110,000. So that looked pretty good. On the face of things. But the breakdown is not quite as good. If we also look at the unemployment rate, that came in at 4.1%. A lot of people had thought that that would actually rise a tenth, but it actually came down a tenth. So ostensibly that looks pretty good as well. Average hourly earnings down 0.2, so less inflationary pressures for the Fed. Again, that was lower than previous and lower than consensus, so that looks good. Average hour, and then you've got the hold on, just want to have a look at the average weekly hours earned. That was down. Okay, so that's interesting that people are actually working a little less. If you look at the manufacturing payrolls, negative, but non-farm payrolls, private, plus 74,000. And a lot of that was government. So let's just look at, I've got a couple of charts here. Let's just look at a bit of a breakdown. And the point I'm trying to make here is that the numbers looked quite good, but we have to keep in mind that all of this stuff is very, very, very seasonally adjusted. Now, of course, statistically, that makes sense, but it's just interesting. If you look here at what kind of jobs were being created yesterday, the vast majority are government jobs in education. Now it's interesting here because it said over, here's the number here, so government jobs. But on a non-seasonally adjusted, that was actually very, very negative, minus 300,000, non-seasonally adjusted. And if we look at the other big sort of contributor, it was healthcare jobs. Now, basically, a lot of these healthcare jobs, they're in sort of, services for aged people and whatnot, which, very good and noble sort of activities. But the reality is these jobs are not traditionally associated with high levels of salary and sort of robust economic growth. And the reality is that a lot of these jobs in the healthcare sector are essentially sort of quasi government jobs in the sense that they're sort of part of government programs. So the point is that most of this, apparently, sort of positive payroll yesterday, one could argue that this is not necessarily reflecting a very healthy labor situation. And you've actually looked at some of the other industries, you look at mining and logging, flat construction, just a couple of thousand, manufacturing negative, wholesale trade. So you look at these things, transport, warehousing, utilities, information, nothing really strong again, except as you can see here, as the aforementioned sort of government jobs and healthcare jobs. And just looking at this here, the government payrolls, you see here the difference between as I was talking about, the non-seasonally adjusted actually was going in a downwards trend, but the seasonally adjusted is adjusted. I'm not going to go into the details of that, but kind of interesting. And again, just from Acomina research here, just to look at some of this is June here, not really great numbers. So the total comes to 147,000. But when you start looking at it again, you see the government jobs was the big contributor here, and not anything much else particularly. So my point is that these numbers don't look necessarily so great once you start looking at them. And of course, we know that we need to sort of incorporate seasonal adjustments statistically. But the reality is that if you look at the raw numbers, they're quite shockingly soft in a certain sense. On the other hand, we did get the ISM surveys and some other things. So the initial jobless claims, to be honest, that was quite good, 233,000. So lower than the consensus number and lower than last time. So that's a positive. And the 4-week moving average for the jobless claims actually ticked down at 2 or 3,000. So you have to say, that is a positive. On the other hand, you could look at a couple of negatives here and say the average weekly hours earned actually is going down. That's never a good sign for a strong economy. The average number of hours earned going down, and also the participation rate was a little lower than expected. So a lot of the analysis and commentary has been looking at the fact that essentially Trump has closed the border And so the number of sort of immigrants, legal and illegal, coming through has been dramatically decreased. And so one of the sort of the theories going around is that the pool of available workers has shrunk dramatically by hundreds and hundreds of thousands. And a lot of people are actually apparently, sort of staying at home and just essentially keeping away from the workplace because of fears of ICE raids by the sort of immigration authorities. So without going into the politics of all of that, the idea is here that the participation rate is getting lower. The pool of available workers is shrinking, especially from sort of undocumented immigrants. And what that's meaning is that if you have less available workers, even with less people working, the unemployment rate can therefore actually be reduced because the numbers of the pool of available workers are reducing. So the point is that even though the unemployment rate did go down to 4.1%, which looks on the face of it positive, maybe it's not so positive. And as I say, participation rate going down as well. So a lot of this stuff, this is very complex stuff. It's a complex number. It will probably take actually months, if not years, to fully understand it. But all I'm trying to say is that some of these numbers are not necessarily as positive as one could at first imagine. On the other hand, we did get the ISM services, and we have to say that overall that was not bad. So the headline number came in at 50.8, which was a little bit better than expected. So that's a positive. We had factory orders, which weren't too bad, positive. And then if we look at ISM services employment, that came in at 47.2, which was lower than last time. So again, if you look at the ISM services, and again, that's a survey, it's not hard data, it's a survey, but one could argue that the employment component of that one was a little bit weaker. So again, this whole idea of, slightly weaker. On the other hand, new orders survey was positive, and the prices paid came down a little bit. So a bit of a mixed bag. And the market took it as being a positive. So if we look at the market reaction, what is interesting is that some of these reactions to the market were sort of relatively short-lived. So actually, sorry, I just want to just go back and show you some stuff. So of course, what we got on the bond market is at the front end of the curve absolutely sort of hated it and went down. So if we now look at the July sort of probabilities on the CME watch, we can see here, this is where we are now at between 425 and 450. So the effective Fed funds rate at the moment is 4.33. And so you can see here that currently this is almost 95% of no change for July. So July was essentially taken out. If we can look at the comparison, not a huge change for the July here, but we can see here that going back one day or even 1 week, you can see that the possibility of a cut has diminished pretty substantially. And if we go, let's go by the end of the year, which is the 10th of December, we can see on the comparison tool as well here is that the possibility of having sort of more cuts went down a little bit as well. So the market at the front of the curve, let's just look at something like the December SOFR contract, which I will find in a second. So there we go, December 25. You can see here just this huge red candle yesterday. So it's about 10 to 12 basis points. So essentially, over the day, about 14.5 basis points. So really, this is by the end of the year. So the market took out about 15 basis points of potential cuts. Now, we have sort of recovered a little bit on that. And it's interesting that okay, we're just looking at the reaction of yesterday. So the front end of the curve really sort of did not like that at all. And if we look at the rear end of the bonds, they also went down. So all of the bonds are going down yesterday. On the other hand, the equity market was pretty happy with it. But what's interesting is the equity market here, as I say, I've got some Fibonacci extended sort of potential levels up here. We're starting to cool off a little bit, although yesterday it was positive. So yesterday we had strength in the equities, a weakness in all across the bond curve, but especially at the front end of the curve that caused a pretty nasty sort of flattening of the curve. And also we had a little bit of strength in the dollar. But what's interesting is that if you look at the dollar, you can see that yesterday, this is the dollar index, we did have a pop, but it's essentially given back, almost, let's say 50% of that already. And if we look at something like Euro USD on the spot here, you can see that dropped yesterday as a reaction to the non-farm payroll numbers, but already, on the converse is sort of gaining another little bit as well. So the point is that the US dollar is finding it difficult to rally on anything. I mean, at this point, You had, relatively strong data on, on the face of it yesterday. The US dollar, which is very, very overextended on the downside, just finding it very, very difficult to get off the floor for more than an hour or two. And maybe, it wasn't helped by Treasury Secretary Bessent making comments. He basically said, over the last 12 hours, he said that, the US government still has a strong dollar policy, but day-to-day fluctuations is simply the market doing its thing. So that wasn't exactly music to the bull's ears. With the Treasury Secretary, sort of, affirming that, yes, the US administration has a strong dollar policy, but they're quite happy on a day-to-day basis for the market to do what it will. So I wonder if that was part of it. Also, what we've been, and again, another things to look at yesterday was just the flattening of the curve, probably the front of the curve, those yields going very high, sort of pushing down the curve. So let's say we look at the 2s, 30s, you see here, it's been flattening for quite a bit. Now, also seeing some flattening this morning, but we are seeing a little bit of the front end come up. So what's going on is that we've had some news on tariffs. Now, keep in mind, today is July the 4th. The famous deadline for the tariffs is July the 9th, which would be next Wednesday. And Trump has been issuing some tweets and whatnot. And apparently the current situation is that the US administration is sending out letters to 10 or 12 different nations. And essentially, if there's no deals, the idea is that the US, they're saying they will impose rates in one tranche between 10 and 20%, and for certain other countries, 60 to 70%. So base of between 10 and 20, and in certain sort of countries, 60 to 70%. And the idea is that these will be paid by August the 1st. So what you can see, if we put it, let's put the charts back onto the 15-minute chart here. If we look at something like the equities, there's been a bit of a risk-off tone. And you can see here the equities basically, since yesterday have started to come down. Now, keep in mind that the cash market is closed. Obviously, it's pretty low liquidity. It's a holiday in the US, et cetera, et cetera. So we need to apply the usual caveats. This just could be, low liquidity, July the 4th morning. But it is interesting that the stock market, at least the US, the ES mini futures are drifting down. And there is a little bit of a risk-off kind of tone. The US dollar has given back a little bit. And as you can see, the bonds, if we just have a quick look at the bonds here, let's look at, let's say, the 2-year. You can see here, this is the big fall after the payrolls. You can see the 2-year bonds made a bit of a comeback. The 10-year bond also has made a little bit of a comeback. So a little bit of risk-off. The market is starting to turn its attention again to tariffs, and just thinking that Trump, who knows, might actually cause a bit more chaos and basically impose at least some sort of base tariff, confirm a base tariff of between 10 and 20%, which you have to say, in theory, is a negative. We also had yesterday, it looks like the final passage of the One Big Beautiful Bill. That made it through the Senate a few days ago, and yesterday the House of Representatives passed that. So in theory, Trump will be signing it today at 5 p.m. on Independence Day. What can we say about that? I mean, essentially, a lot of people are saying it's stimulative, but what it does is to extend pre-existing tax cuts, which you have to say in terms of the status quo. I don't know how much that will actually change the status quo and sort of be stimulative. On the other hand, definitely they're taking out some red tape. There should be a little bit more deregulation. The tax cuts, one could argue, they're still there. So that's probably sort of a good thing, at least for high income earners and sort of corporations. There hasn't been as much sort of cutting in terms of the deficit. So one could argue that is, I don't want to say it's stimulatory, but it's not sort of austerity, let's put it that way. And secondly, what does that say? It's basically saying that, there still could be substantial issuance of long-term bonds. So just going a bit more medium term, the Treasury is trying to manipulate sort of the yield curve. We know that Trump and Bessent want the 10-year yield down. They're talking about sort of funding the TGA, which is like essentially the US Treasury's account at the Fed, with bills, making it really substantially, or bills very short term rather than longer term. But the point is that, with continuing issuance, inflation seems to be sticky, and maybe we are going to get these sort of inflations and not too much sort of cut in the deficit. You've got to say that, the direction of travel probably should be a steepener, which means, higher yields on the long end over the sort of the medium term. But let's see how it all sort of, wraps up with the with the tariffs next week. Could be quite a lot of volatility around tariffs. As I say, just looking at the 15-minute chart, you see here that the euro initially sold off, but it did recover and now it's kind of sort of stabilizing quite well. Other thing I want to look at here, just going back to a daily chart, is oil. We have an OPEC plus meeting, and it's interesting. We all know what happened with Iran and Israel and everything, and then oil's in a sideways sort of consolidation. It did pop out. I thought it was just a technical sort of squeeze here, but as you can see on the chart on the daily here on the front contract, the last couple of days it's given it back a little bit. Now, could that be worries about tariffs, or could it be the fact that we have this weekend, actually tomorrow, there's a remote meeting by Zoom, sort of essentially by OPEC plus, and what everyone's essentially saying is that it's quite probable that they will continue to push up their production by another 411,000 barrels per day. Now, keep in mind that that would be the fourth consecutive sort of increase of production, and keep in mind as well that that number of 411,000 is actually triple. It's 3 times what they originally agreed, a few months ago. So definitely the OPEC plus is deciding to sort of push out more production. I was just reading this morning on some research that, according to the International Energy Agency, global inventories are now starting to grow by about 1 million barrels a day. So we're definitely starting to get more oil coming onto the market. And as this is what's happening here, just being reflected that the market is just finding it difficult to rally in a significant and sustained way. And maybe, of course, the question would be, okay, if we get concerns about global growth and tariffs causing a slowdown in the global economy, why would the Saudis especially want maybe to push up oil production? And it seems that with the idea that they would have lower prices, of course, and it seems that they're a little concerned that they've lost out a lot of market shares and they want to sort of pressure some of the more marginal producers. And just keeping that in context, especially from the US context in WTI oil, there's an interesting survey which the Dallas Fed does. I don't know if it's every quarter or every year, but anyway, it came out a day or two ago. And basically what they do, they ask, he got 85 exploration and production firms, which they asked last week. Essentially, what would happen if WTI oil were to remain at $60 a barrel over the next 12 months? What would you expect to happen to your firm's oil production over the next year? And so it's interesting here that they would decrease at $60 a barrel. Now, keep in mind that the current price of oil, it's about sort of 65, 68, 70 in that there. So basically, if it was about $60 a barrel, you see, a decrease slightly. This is the level. But what's interesting is that as soon as the same question is asked, so not $60 a barrel, but boom, $50 a barrel, suddenly you've got a lot more. So you've got decrease significantly. You've got 45% of participants of these companies, 85 exploration and production firms. So the conclusion here is that really the sweet spot, or not really the sweet spot, let me rephrase that. The pain point does seem to be down in the 50s. So maybe what's happening here is that the Saudis, who obviously are very aware of all these dynamics, and other members of OPEC Plus, maybe they're looking at this and saying, hey, it's time to put a bit more pressure on these American, the shale producers. So, with prices up here in the 60s, maybe what the Saudis are saying is they can get a bit more market share, produce a little bit more, keep Trump happy at the same time, and basically push, if the price does go down, down a little bit here, down into the early 60s, late 50s, mid 50s, down here somewhere, that would put significant pressure on a lot of the US oil producers who, as we've seen, would actually sort of decrease production, and that would allow the Saudis maybe to sort of step in and regain a little bit of market share. I don't know, maybe that's part of the thinking. That's certainly, what some people are saying is sort of part of their thinking. Let's see what happens over the weekend. Okay, I think I'll leave it there, guys. As I say, it's probably going to be a fairly quiet morning. Trump is tweeting still July the 4th, so there could be more stuff on tariffs coming out. The futures markets, depending which one, essentially will be closing early today and reopening again on Sunday evening. So let's watch the oil market on Sunday evening as well. If there's anything from either on the tariffs, well, let's say from the OPEC Plus, and then more generally from the tariffs. Okay, guys, have a great day. Those of you in the States, enjoy Independence Day. Thank you.